All right, welcome back to infrastructure investments. So we are going to look at these valuation matrices. We are going to evaluate creditworthiness, and we are also going to calculate GP fees. These are formulas that you are familiar with. You remember the loan to value ratio, which is calculated by getting the debt outstanding and you divide by the current project value. And this is the debt service coverage ratio, which is obtained by calculating the net cash flow from operations divided by the debt service. And the equity dividend rate is calculated by taking the before tax net cash flow divided by the equity invested. The before tax cash flow is calculated as the net cash flow from operations minus the debt service. Okay, so there's nothing new here in terms of these valuation matrices. These are exactly the same matrices that we used in private real estate. And then the GP fees, this is how we're going to calculate them. This first part is just the management fees. We are going to use the value of the firm at the end of a particular period, or the value of the asset at the end of a particular period. So let's say after a year, the firm has accumulated cash flows of 20, and initially we had invested 100. It's going to be 120. So this is the end of period value of asset. This is the management fee, the percentage of the management fee. We are going to add, either we add a 0 if we do not surpass a particular hurdle rate, but if we surpass the hurdle rate, we are going to take the value of the asset at the end of the period multiplied by 1 minus the management fee. Then we subtract the initial value of equity multiplied by 1 plus the hurdle rate. And then everything is multiplied by the performance fee, which I put P here. But I guess to make things easier, you could just call it RP as the performance fee. I'm going to do a quick example with very simple figures that I put together so that you understand how this formula works. It looks complicated, but there's nothing to it. You will see just now what I mean. An investor contributed 1,000 rands in equity to a private equity firm, and the firm charges 1% for management fees and 20% for performance fees on returns that exceed a 10% hurdle rate. So you see from here that the management fee, the RM, is 1%. The hurdle rate is 10%, so the RH is 10%. And the performance fee, instead of using P, I'm just going to use RP. It's going to be 20%. And the equity that has been invested is 1,000. So the P0 is 1,000. Okay. And now, remember that the management fees are going to be given, the GP fees, actually, the GP fees, the fee for the GP, are going to be given as the end of period value multiplied by these management fees, plus we get the maximum of two values. Either we are not going to add anything. It means whatever comes after this, if it's a negative, then we don't add anything. But if it's a positive, we add this side, the end of period value multiplied by 1 minus the management fee. And then we subtract the equity price multiplied by 1 plus the hurdle rate. And then the answer we get here, we have to multiply it with the performance fee. This is similar to what we've been doing. To say if your amount exceeds by a particular amount, the hurdle rate, you just subtract the values and multiply by the performance fee. So this is the performance fee, the hurdle rate, H, P for performance, H for hurdle, M for management. Let's look at the first one. Question number 1. After these 3 years, our asset value is 1,200. So the return for GP, the GP fees, are going to be this 1,200 multiplied by the management fee, 1%. And then you add maximum of the two. Either it's going to be 0 or it's going to be this 1,200 multiplied by 1 minus 1%, 99%, minus the equity, 1,000, multiplied by 1 plus the hurdle rate, 10%, 1,1. The answer you get here, you have to multiply it with the performance fee of 20%. Okay. And then if you solve this, 1% of this is 12 rands, plus you choose the maximum of two numbers, either this 0, or if you subtract these two numbers and multiply by 20%, you must get 17,63. All right, so it's obviously going to be 12 plus 17,63 because it's greater than 0. If you add these two, you're going to get 12 plus 17, you're going to get 29 rands and 63 cents. This becomes the performance fees, the GP fees. For the second option now, you do the same thing. The GP fees, you take the 1,050 and you multiply this by 1%. And then you add the maximum of the two, 0 or 1,050 minus, multiplied by 99%, 1 minus the management fee, 99%, minus 1,000, the equity amount, times 10%. The answer you get here, you must multiply it by 20%, the performance fees. If you do this, if you multiply these two, you're going to get 10 rand 50 cents. Then you add the maximum of two numbers, 0 or this one is a negative. So this was a negative, I think it was negative 72.1, I'm not sure, but whatever the answer was, it was a negative. If you add these two, this becomes a 0, just 10 rand 50 cents plus 0. So this amount is going to be 10 rand 50 cents. So that becomes the answer there. So this is sort of a short practice with simple numbers so that you understand how to use this formula. Okay, so let's go to this practice exercise. As I always say, pause the video, give this a try, and then we do it together. In this instance, we want to calculate the debt service coverage for the first full year of operation, which is year 4, for the TBA project, given that the net cash flow from operations is 100 million. Okay, so to calculate the debt service coverage, we are given the net, this, because the debt service coverage is simply the net operating income divided by the debt service. We are given this already. This is given as 100 million. What we want is the debt service, and it's going to be based on, so this one is a bit more tricky as opposed to what we've been doing, where we're just calculating the periodic payments in the financial calculator and multiplying by 12. In this instance, we have a very complicated debt structure, and we need to see how much we have to pay for in year 4 for each, whether it's the senior debt, the junior debt, the bank loan. We have to determine the debt service, how much we are going to be paying in the first year of operations, which is year 4. For instance, let's look at the first one. The International Finance Corporation, IFC, senior loan, it's 150 million. The interest is 60%. And it's fully disbursed at the end of year 2, linked to project milestones. Accrued interest is capitalized in year 3 and paid in year 4. So it's not paid in year 3, it's capitalized and paid in year 4 on full balance outstanding. The loan is repaid in 12 equal installments comprising principal and interest payments starting year 5. Secured by TBA assets. So this debt is secured. So let's look at this one. We want to see what's the debt service based on this one. All right. So what is the debt outstanding? The debt outstanding is going to be equal to, you take the loan amount 150 million, and then they say this money was fully disbursed by end of year 2. So which means it's capitalized, the accrued interest is capitalized in year 3. So in year 3, there's going to accrue an interest of 6%. So there's an interest accrued of 6%, which means the debt outstanding by the end of year 3 is going to be 159 million. 159 million. All right. And then they say that, and paid in year 4 on full balance outstanding. So it's going to be paid in year 4 on full balance outstanding. This is the balance outstanding, which means in year 4, the debt service would then be equal to this amount, 159 million, multiplied by the 6%. And this should give you an answer of 9,540,000 is the debt service for year 4. Okay. Let's go to the next one, this one now. This is a senior syndicated bank loan. It's 235 million, 7% annual interest paid annually on balance outstanding, fully disbursed at the end of year 3, linked to construction, full balance outstanding for 3 years with principal amortization in 4 equal annual tranches thereafter, secured by TBA project assets. So it's also secured by TBA project assets. And this one is easier because it's just disbursed in year 3. So it has been 1 year since it was disbursed. So interest is only paid on 1 year, which means you take this amount. So in this instance, the debt service, let me just say DS for debt service, is equal to the entire loan amount and the interest percentage, 7%, 7.5%. If you multiply these two numbers, you must get 17,625,000. That's the second one. All right, let's go to the third one. The third one is a loan bank, ECA guaranteed. You remember ECA, which I said it's also important. You need to understand there's export credit agencies which are responsible for guaranteeing credit insurance and political risk insurance. These are important for some firms that interact with foreign markets. Anyway, that's not what's important here. What's important is that this debt is 100 million and it pays a 6% annual interest, right? At the end of year 3, linked to export delivery. So it's at the end of the year 3. Interest is paid on full balance outstanding for 10 years with full bullet loan repayment at maturity. All right. So the payment for this loan, it's also quite straightforward. The debt service is just this 100 million. is the 100 million multiplied by what? 6.5%. If you multiply these two numbers, you should get 6,500,000. Okay. Let's go to the fourth one. Junior construction and development loan of 100 million. 9% annual interest accrued on outstanding balance. Okay. Immediate disbursement. So it's disbursed immediately when the project starts. And equity drawn down. Capitalized interest and principal are paid in 4 equal installments starting at the end of year 14. So in year 4, there's no debt service. This debt is going to be serviced in year 14. So we can forget about this. Subordinated claim to TBA project assets, which is repaid only. Senior creditor claims are paid. Once senior creditor claims are paid. So there's no debt service in this instance. But what we need to determine is the debt outstanding in year 4. And the debt outstanding in year 4 is going to be equal to this amount of 100 million. After 4 years, because it was disbursed immediately, so it's 4 years, we take the interest of 9% to the power of 4. And then when we multiply these numbers, we must get 143,766,095. And the debt service, the debt will only be serviced 14 years from now. So there's no debt service here. Okay, so to get this denominator here, we add up the debt service. So the total debt service would then be equal to 9,440,000 plus 17,625,000 plus 6,500,000 plus 0, and then you're going to get 33,665,000. Hence, the debt service coverage ratio is the net operating income, which is 100 million, divided by this 333,665,000. Then if you divide these two numbers, you should get the debt service ratio equal to 2.97, and this becomes your answer. So I hope you managed to do this. I hope you managed to calculate this. Let's go to the next question. All right, let's do the next question. Solve the loan to value at the end of year 4 if the TBA project has a value that is appreciated by 10% above its original development cost. I put the development cost here. Remember, the loan to value is simply given by the outstanding debt. The debt outstanding divided by the current project value. Okay, the current project value. Okay. Now, the current project value is easy. This value here. We are just told that there is a 10% appreciation above the original cost. So the current project value is just the original cost. This is the project development cost, 900 million multiplied by the appreciation of 10%, 1,1. What we need to get is the debt outstanding. Try figure this out, and then I'll show you how we do this. But we are simply going to go back to the values we were calculating and add them up to get the debt outstanding. Then we divide by this number here. Let's see. Let's go back a bit. Okay, so the numbers you have to add are these ones here. The debt outstanding, the interest had accrued, and we had this outstanding debt of 159 million. And then for 2, the debt outstanding, we only paid the principal. So the debt service, we only paid the principal. So this amount is still outstanding. We only paid the interest, so the principal amount is still outstanding. Same applies with 3. We paid the interest and this principal amount is still outstanding. Year 4, the entire amount with interest is still outstanding, which is this amount. So we have to add these numbers to get the final debt outstanding. Okay, so let's go to the next page and add the numbers, and then just remember this is where I got the numbers, just in case you get confused somewhere somehow. All right, so we are saying the debt outstanding is the 159. I'll put 3 zeros, and the full principal 235, and the full principal for the third one, the full principal was 100, and for the last one, it was all accrued for 4 years, 143,766.095. Okay, so if you add all of these, you must get the debt outstanding of 637,766.95, and hence the loan to value would then be equal to the debt outstanding 637,766.095, and then you divide this by the current project value, which is 900 million, multiplied by an appreciation of 1,1, and then once you solve this, the loan to value, you must get 0,644. Okay, I hope you managed to do that. Let's move to the next one. Calculate the equity dividend rate for the first full year. So I want you to try this first before we do it together, as well as the GP performance fee. And in this case, you ignore the management fee, which actually should make your life easier because you're ignoring the first part. You're just looking at the maximum to say if they exceed the hurdle rate, then there's no management fee. The management fee is 0, right? So you just need the P1 here minus the P0 times the hurdle rate, 1 plus the hurdle rate, and then the answer you get here, you multiply by the performance fee, and then it makes life easier. But anyway, start by calculating the equity dividend rate, and then come here to get the GP, the return for the GP. The equity dividend rate is the before tax cash flow divided by the equity. The before tax cash flow is the net operating income minus the debt service. All of this should be divided by the equity. We know this was 100 million, it's given. This value was given, 100 million. And we calculated the debt service in the previous question was 33,665,000. The equity is given here, which is 315 million. If you solve this, you must get 21.1%. So this is the very simple, the equity dividend rate. It's done. Let's now go to this GP fees, and then we ignore the management fees. So the return for the GP is simply going to be, we are told that 25% with remaining 75 equity drawn in 3 stages, doesn't matter. GP fees upon completion are 10% of returns above the hurdle rate. Okay, so what is going to be this return? So this is the after a period, this is the return after a particular period, right? And we said the return after the period, this P1 is given by before tax cash flow plus equity. This before tax cash flow is this 100 million minus 33,665,000. This before tax cash flow, we get it from here. If you subtract these two numbers, you must get 66,335,000. So we are going to take 66,335,000. Then we add the equity, which was 315 million. We add these two. That's how we get our P1. So we want the maximum of either 0 or P1. Our P1, if we add these two, we must get 381. This P1 must get 381,335,000 minus, we are now going to subtract the equity, which is 315 million. We multiply this value by the return, performance return. So we multiply by 1 plus the hurdle rate, right? We multiply by 1 plus the hurdle rate, which is 1.15. Then the difference of these two is what we are going to multiply by the performance return. Performance fee is 10%. So we multiply this by 10%, which is 0.1. We solve this, and this is a positive, so the 0 is out. Our answer is going to be equal to 1,908,500. That's the answer you should get. Put these numbers in your calculator. You should get this answer. All right. So that's how you get this. I hope you managed. It's the only difficult part was the first part with that complicated debt structure. But after that, it becomes as easy as cutting margarine with a hot knife on a hot day. Right? Yes. Okay, then. We are done with this. Your favorite part of learning after practice is homework. Do your homework. So these are the questions. This question, it's similar to what we're doing in private real estate, but you're going to have to generate this table using Excel. Calculating all of this one by one, it's going to take you forever. Just do 1 or 2, and then the rest do them in Excel. You do 1 or 2 to make sure you know how you do it, right? Because they might leave a gap in the exam and say, what's the number here? Then you start sweating. So try do them by yourself, and then so calculate and show the ratio of equity to total capital monthly for the first year. It's for the entire 12 months. The ratio of equity to total capital, you want to get this column here. All right. Then the second question, calculate the loan to value at the end of month 12 if the project's value costs in terms of debt and equity. So you have this debt and equity, and remember the loan to value we said the loan to value was it's simply given by the outstanding debt, the debt outstanding over the property value, over the value, right? And we said this debt can be written as value minus equity over value, which means it can be 1 minus equity over value. So the loan to value can simply just be 1 minus 0.37 in month 12. You can calculate it like this, and you get, what answer do you get here? 0.63 probably, but you will try it. It's your homework. You will give it a try and see if you get this. We'll do these questions together and then calculate the debt service for the first year after completion using VAL's expected first year of revenue. So with the expected first year of revenue, you have the net operating income, and with the debt service coverage ratio, what you want is the net operating income. Then you divide by what? The debt service. You divide this by the debt service. Okay, so you need to determine that this one is given. The net operating income is given. All right. And then you want to calculate the equity dividend rate and also the GP performance fee, ignoring management fee. This thing of ignoring management fee actually makes things easier because you ignore the first part of the equation and you just put the last part, the maximum of either the 0 or this price that is appreciated multiplied by management fee. It's ignored, 1 minus that. So you simply then subtract the equity price, which is multiplied by the hurdle rate. Then the answer you get when you calculate the difference here, you multiply that by the given performance fees and you get your answer. So this is just calculating P1 minus P0, 1 plus the hurdle rate. Then the answer you get here, you multiply by the performance fee. All right, and in this instance, the performance fee should be given somewhere. You will see in those questions, you see the performance fee somewhere, right? But this basically is your homework. Give it a try, and then we're going to do it together. So we're going to do the homework. Soon after the homework, it will be one video for the homework, and after that we jump into due diligence. All right, I hope you are enjoying this. I'm loving it. Anyway, Mr. Mash is out. Enjoy private infrastructure investments. Peace.